The past holds the key to the present. It's time to uncover the truth.
Look at this diagram. This single block represents the total financial value of the entire global economy. Now, look at the block next to it, dwarfing it at over 3 times its size. That is the global debt, $300 trillion. To understand how a number that large even exists, we have to look back to the 2008 financial crisis. Central banks, like the Federal Reserve, needed to force start a frozen economy, so they dropped interest rates essentially to zero. When interest rates hit zero, the math of borrowing changes. Taking out a loan carries almost no penalty, making money effectively free. Without the friction of interest payments, governments spent heavily on infrastructure. Corporations took out massive loans to buy back their own stock, and individuals leveraged themselves to buy homes and cars. The world went on a decade-long borrowing spree. Then, in 2020, global commerce suddenly halted. To prevent immediate total collapse, governments were forced to borrow and print trillions of dollars more, injecting even more cheap cash into an already flooded system. Flooding the economy stopped the immediate bleeding, but by building a decade of growth on the foundation of near-zero interest rates, we created a system that can only function if money stays cheap forever. The trigger arrived when the cost of groceries, housing, and fuel started rapidly climbing. Inflation had returned. This chart tracks the primary weapon against inflation. After decades resting near zero, the line violently spikes upward. The entire $300 trillion debt ecosystem was engineered exclusively for 0%. Apply the pressure of rapidly rising rates, and the structural integrity fails. The bill for a decade of free money is finally due, and the pressure is already fracturing the global economy across 3 specific stress points. During the cheap money era, many developing nations chose to fund their domestic growth by borrowing heavily in US dollars. Now, look at the dual threat they face today. As the US raises its rates, the US dollar gets stronger. For a foreign nation, their local currency shrinks in value against the dollar, meaning the exact same loan requires a physically exponentially larger payment. We are looking at a scenario where entire sovereign nations run out of the capital required to function, leaving them unable to pay for basic imports or service their populations. The math is clear. The first casualties of this debt mountain are whole countries. In the private sector, we find zombie companies, corporations that fail to generate enough actual profit to even cover the interest payments on the debt they already carry. This flowchart tracks their survival. For years, zombie companies took new, zero-interest loans to pay off old ones, creating a seamless loop. But today, new loans carry heavy interest rates. The cost of rolling debt over becomes fatal, and the cycle shatters. Thousands of corporations that functioned normally a few years ago are now structurally doomed, setting the stage for wide-scale layoffs and sharp stock market declines. The pressure eventually forces its way down to the individual. Macro interest rate hikes from central banks directly translate into incredibly expensive mortgages and auto loans for the average citizen. When the basic cost of keeping a roof over your head and a car in the driveway consumes the vast majority of a monthly paycheck, discretionary spending freezes. People stop buying extras. Consumer spending is the primary engine of the broader economy. When millions of households freeze their wallets and eventually default on their housing, that engine stalls out, dragging society into recession. This means the global debt problem is actively eroding the foundation of middle-class survival. If developing nations, massive corporations, and millions of homeowners are all failing to make their payments at the exact same time, who ultimately absorbs that loss? The global banking system. These institutions hold the trillions in debt from all 3 sectors we've just looked at. If countries, corporations, and homeowners all begin to default together, the losses aren't limited to a single market, making the potential contagion path broader than the housing-specific collapse of 2008. Debt used to build productive infrastructure drives growth, but debt used entirely to fund immediate consumption and mask underlying weaknesses operates like a ticking clock. We've spent over a decade delaying the inevitable by continuously rolling over our balances. That era is over. The pressure is already breaking the system. The only question left is who falls first.